Howdy, Jacob here. Today we're looking at Dick's Sporting Goods in the specialty retail industry. 16.8 billion market cap on a little bit less enterprise value. Incorporated in 1948 out of Pennsylvania. They sell hard lines, sporting goods, fitness equipment, golf equipment, fishing gear, etc. Their growth in revenue has been pretty impressive, honestly. Way more than I would have thought. 6.8 billion in 2015 to 12.9, almost 13 billion in 2024. So almost doubling revenue. And you have gross margins increasing, operating margins increasing, dividend increasing, return on invested capital also increasing. I mean, a lot of things looking very promising here from an initial numbers standpoint. Their balance sheet shows 1.8 billion cash on hand, no short-term debt, 1.5 billion long-term debt. They have enough cash to write off that debt, so we're not concerned with that. Capital leases make sense. They're a retail store, so you're going to have to give balance in your assumptions for them being retail, but darn if they're not performing well, that's for sure. Their depreciation amortization has almost doubled, actually over doubled over the last 2 years, or 10 years, sorry. Capital expenditures have gone up less than double, and cash from operations over doubled. So free cash flow production is phenomenal, with majority of their money going towards giving money back to shareholders. So to me, when I see this huge return on invested capital, that makes me feel good. But again, if they're not reinvesting back into the business and they're just buying back shares and paying a dividend, they don't deserve that premium, in my perspective. Although they have the capability to possibly get those rates of returns based on history, they're not reinvesting to get those rates of returns. So to me, that dampens their any sort of premium that you might give for any other company that does reinvest at double-digit historical rates of return. But either way, use of cash of share repurchases and dividends, that's fine. Their share repurchases are also inflating their return on invested capital figure due to that denominator being dampened, which increases that ROIC ratio. But yeah, I think we're ready to make some assumptions here. So I think as for revenue growth, there's so much competition in the specialty retail industry. I think that, Dick's has been around for quite some time. I think that they're not going anywhere, but I do think that they will have to, dampen some margins maybe to be able to compete with some of those online businesses that, they just have less costs, less expenses. So for me, I think they will be able to grow with inflation. I think that that's very reasonable. I think they deserve, almost historical average of P, price to free cash flow. Margins, I will dampen a little bit due to, again, competition. Whether I'm right here or not is a different story, but I think I'm going to be more comfortable with what is the average here? 7.7. Let's do 6 and 7 with share changes of, buying back 1% for them is about 168 million, 170, 340, 400, 400 million for 2% seems reasonable, given that, I mean, maybe that's too much. Yeah, let's do 1%, and then because their dividend is pretty high right now, so let's keep that dividend flat over the next 7 years. So we're saying, maybe so on 13, 6%, 13 times 7%, 900 mil. On 900 mil, about 350 going to dividend, and then 200 going to share repurchases. Okay, maybe I can do 2% a year if I'm comfortable with that. So this is assuming roughly 50-50 on dividend share changes, or I guess 40-40, leaving about 20% to acquisitions, reinvestment to get, to be able to compete with those online businesses. But for me right now, yeah, it needs to fall 55% before you get the return we're looking for here. So interesting business. A lot of the numbers looking pretty promising, but when I look prospectively, I just see a lot of competition, and I could be wrong. Maybe they have some sort of moat that I don't see. But for me right now, these are my thoughts. Hope you enjoy the video. Have a great rest of your day.